You know what? I'm not leaving. I'm not leaving. I'm not fucking leaving! The show goes on! This is my home! They're gonna need a fucking wrecking ball to take me out of here! They're gonna need to send in the National Guard or fucking SWAT team, cause I ain't going nowhere! Fuck them!
Welcome back, my hooligans and delinquents. And I hope you're all having a fantastic day, as I'm back with this aggressively average content after what I'd like to call my magnum opus, my greatest XRP video ever, the 100 reasons why XRP will hit new all-time highs in 2024 has been posted, and we've been getting absolutely great feedback from it. Ladies and gentlemen, I created it as a be-all, end-all, one-stop shop for your XRP information that you can reference constantly, and it was my last XRP video. I am currently transitioning my channel to becoming more important than just XRP information. And while I did say it is my last XRP video, we will still discuss XRP on this channel, because what's about to happen next in the market is going to be seismic. We are going to be experiencing a March 2020-like scenario. And I need to remind you, for the sake of this video, that the World Economic Forum themselves has warned that the biggest threat to the globe is a cyber attack with C-19-like characteristics. We are in Blackswan territory, the biggest one yet, and anything could happen. There was a movie put out on Netflix, produced by the Obamas, citing a cyber attack as the biggest threat to America. And I wouldn't be surprised. And ladies and gentlemen, on that note, I have to remind all of you, in perfect alignment with the financial period in time we're in, and also the narrative I'm discussing, the U.S. Cybersecurity and Infrastructure Security Agency was hacked this week with a zero-day exploit. No media organizations are talking about this, but you better believe here, I'm preparing the masses for what's likely to come. And while I play this video, I'm going to explain to you what it all means, as I'm really glad to be back, speaking with every single one of you.
The breach involved vulnerabilities in products by Avanti, which is a software company. These affected systems were crucial. One facilitates the sharing of cyber and physical security assessment tools across federal, state, and local levels. The other holds sensitive information on the security assessment of chemical facilities. Why is this a big deal? Well, number one, not a lot of articles that I'm reading out there are pointing out the fact that the data that has been stolen at this point, or the data that was stored on these systems and has been accessed by these hackers, and I'll get into who they were in a minute, you have to understand that data and assessments has to be treated at the highest level of security and sensitivity. These are essentially all the things wrong that are in your network or that are in your computer environment that somebody could potentially exploit in a hack or exploit for no good. This is why you run regular assessments, so you can identify these vulnerabilities and start working on remediating them and getting rid of them in your environment. And unfortunately for CISA, the systems that were hacked were chock full of this information across all kinds of governments, from federal to state and local. So you potentially have a foreign country who has infiltrated a US government network and now has a library of information about the other computer networks of other other state and local agencies and organizations, and municipal governments and state governments. That is an enormous amount of information that you do not want falling in the hands of your adversaries. It's not good information that I'm delivering here, folks. You want to treat these assessments and the reports and the information in these, like I said, with the highest level of sensitivity and security because of the damage that can be done when somebody gets their hands on these. So it's my belief that this hack on CISA is a bigger deal than kind of a press release or a few articles. I think this is going to lead to other state and local governments getting breached by these hackers, or potentially, who knows what's going to happen with this information. We don't know. It's alarming at a minimum, and this could be a major, major impact on our national security moving forward here in the very, very near future. So this is the impact to you as a citizen of the United States, that your government, your local government, the governments that you rely on, your states, your courts, they could all end up being victims as a result of the information that was stolen in these attacks.
Now, ladies and gentlemen, why did I start off this video in this way? The reason is because you need to remember the past to try and prepare for the present. This is from the Johns Hopkins Center for Health Security page, and this page is titled Event 201, where Johns Hopkins partnered with the World Economic Forum and the Bill and Melinda Gates Foundation for a Event 201 high-level pandemic exercise when October 18, 2019. This was right after the repo liquidity injections happened in the banking system, and this is in alignment with the first initial C-19 cases. The reason I'm bringing this up is because so coincidentally, when these people are having events and warning of certain things, they just happen to come to fruition. Event 201 and C-19 were the simulation. This time around, it's the real thing. When they've been warning about cyber attacks for as long as they have been, you need to be prepared, and it's likely to happen sooner than we all expect. And ladies and gentlemen, the reason this is so important is because right here, right now, we're on the precipice of a crypto bull run, while simultaneously watching a banking failure happen. They fill in their Black Swan events with banking failures and financial changes. And I want you all to watch the dominoes fall properly in this direction. You see, right here, right now, we're going to dive into why banking failures are going to start in short order. And we're going to dive deeper into what's under the hood, because the Fed just stopped their emergency funding. And we're going to see the cracks in the system very, very soon.
Why exactly does Fed Chair Jerome Powell say that small and mid-sized banks are in trouble? And more importantly, is it all by design? Is it intentional? Let's dive a little bit deeper, shall we? The first thing to note here is that the Federal Reserve is going to back off from its plan to require banks to hold higher levels of bank capital, which was the requirement, of course, implemented following Silicon Valley Bank collapse last year. Higher levels of bank capital effectively ensure that banks have more liquidity to potentially deal with bank runs. Now, the Fed knows that due to extremely high exposure to commercial real estate portfolios that are losing value as we speak, banks are going to have a really difficult time dealing with billions of dollars in loans that are due for refinancing this year. Yet, the Fed says, don't worry about it. You don't need more cash to cover those bad loans. We will just fold you into a bigger bank and your customers won't even notice. Or as an alternative, taxpayers will be forced to bail out those depositors of failed banks. Those are the two likely outcomes. Jerome Powell's comments highlight looming liquidity challenges for smaller and mid-sized banks. On March the 11th, the Federal Reserve will hold its support through the Bank Term Funding Program. There is a very good chance that it may trigger a ripple effect across the banking industry, especially as there is so much instability and this growing sense of stress that consumers are facing as they're taking on more and more debt. This crisis has the potential to have a massive ripple effect across global economy too, primarily because the United States dollar is the global reserve currency. If you're not familiar with how the Bank Term Funding Program works and why it's been keeping many banks open for the past year, really quickly I would like to explain. This program was established following the banking crisis of early 2023. The program was initiated by the Federal Reserve and it offered 1 year in length to banks, credit unions, and other depository institutions that want to pledge U.S. Treasuries, agency debt, and mortgage-backed securities, as well as other qualifying assets as collateral for these loans. And here's the catch. These assets are valued at par in order to give out these loans. While the market value of these assets is in red, it is negative. It cannot be sold without taking massive, truly massive losses, which is why these banks would rather hold on to their devalued assets, keep them on their books, hoping for lower rates in the near future, and then use those assets to get loans from the Fed. And so the Fed is valuing these assets at par, not their decreased market value, to prop up these banks. This is how many smaller banks manage to stay open this long. Once this program expires, however, and the Federal Reserve keeps interest rates higher until at least June of this year, there is a very good chance that regional banks and community banks will start having major troubles maintaining liquidity, partially because they hold truly massive amounts of commercial real estate debt. I have several videos where I explain this in further details. I won't repeat it today, but I will link those videos for you in the description below. There's a very good reason why foreign central banks have been stockpiling gold. This is all related. Gold has just hit a new record high, driven by central bank demand, not by investors' demand. It's the central banks that are getting rid of their foreign currency exchange reserves denominated in dollars and buying more and more gold. Everyone is looking for safe haven assets. Gold and Bitcoin, both of which are considered hedges against systemic risk, have reached record levels as the result. And so as central banks stockpile gold at absolutely unprecedented rates, it has become absolutely clear that they anticipate the decline of the United States dollar.
Now, ladies and gentlemen, as we're fast approaching the Black Swan event of Black Swan events, we need to understand it's because the financial system under the hood is getting revamped. $53 billion is due to be repaid March 22nd with a total of $79 billion by April 5th. This is unsustainable and impossible to repay. Our economy is going to shit. 08 style bailouts are needed, or else we are all fucked. Ladies and gentlemen, I wouldn't be surprised to see our rate cuts happening all at once in an emergency manner to re-stimulate the economy. And I wouldn't be surprised to see a March 2020 style V-shaped C19 crash in markets. We are overheated across all markets. We need an aggressive pullback. And I think it's going to happen soon. We need to realize that everything happened now is a coordinated dismantling of everything in order to consolidate power into some of the biggest banks in the world. New York Community Bank has been absolutely imploding. This is an example of what's going to happen to all the other small and mid-sized banks. By the time everything is said and done, JP Morgan, Bank of America, and maybe another couple banks will be the only ones standing as they consolidate power. With the increase of bank failures, this will be fantastic to see. And I'll tell you why. It's because as all these banks are consolidating power, there is a liquidity crisis afoot. And I've always stated, since the dawn of my channel, XRP will rise out of the ashes of a Black Swan event and a financial liquidity crisis. We are coming to the moment where this SEC case is almost over. We are coming to the moment where XRP could legitimately be used. And if that is in fact the case, oh my goodness. Look at how everything is aligning perfectly for the perfect XRP bull run. As March 22nd, as we'll be experiencing a crisis in the financial system, XRP's automated market makers will go live. Passive income in the XRP community is coming, and you all should be extremely excited. At the exact same time, Credible Crypto points out that the XRP/Bitcoin chart is unbelievably suppressed, but both the XRP Bitcoin and XRP Ethereum charts printed and confirmed bullish divergences. This right here is something you will need to pay attention to. As this Bitcoin XRP chart gets lower and lower, that just screams more and more that we are in the end stages of Bitcoin outperforming XRP, and it's likely XRP begins taking center stage. These are the things you need to pay attention to in order to make money and front run the market. And these are the things we're privy to on this channel every single day. Now, I think what's important is that you all understand my hypothesis of XRP being used in a liquidity crisis is not far-fetched. It actually comes from the Ripple CEO himself. The CEO of Ripple, Brad Garlinghouse, was asked what role XRP can play in alleviating a liquidity crisis. And remember March 11, 2024, just a couple days ago, the Federal Reserve shut down their bank term funding program, stopping new loans from being issued. This could be what causes a liquidity crisis, and on-demand liquidity will be the solution in one way, shape, or form at some point down the road. March 17th, SEPA goes live activating cross-border instant payments. And March 20th, FedNow goes live activating instant payments. You tell me if you see the XRP perfect storm, because I do. And there are way too many people in the world sleepwalking their way out of this opportunity.
I love the easy questions.
You might not love this one.
Uh-oh.
But I'd pay all my XRP to have you answer it. Maybe not really. With Ripple focused on providing on-demand liquidity and the world facing what's probably the biggest liquidity crisis ever, what role do you see XRP and XRP Ledger and similar technologies playing in alleviating such a crisis?
Well, so if you think about like what causes those kinds of crises, one of the dynamics, and by the way, there's lots of inputs into a crisis like that. One of them is friction. One of them is time. If you can reduce friction as measured by time and cost, that's good. That's just a good thing to minimizing, the risks of liquidity issues. Like I don't pretend that XRP is a panacea for all of these issues. What I do believe is if we can successfully integrate into the existing system, we're going to more rapidly bring the benefits of these technologies to a much, much, much broader audience than if we try to circumvent the system. So I've been incredibly pleased by the engagement we've had, ranging from the IMF to, central banks. And look, Ripple's going to continue to work with those players. That's part of why we made the announcements we made this week about expanding, or really creating our presence more concretely here in Washington, D.C. And I'm optimistic that if these technologies continue to propagate across correspondent banking, but other industries, that's going to be good for any liquidity crisis.
Now, ladies and gentlemen, I find no better way than to cap off this video for today with my favorite generation in the history of mankind. Man, look at this boomer speaking on the screen right now. You see, the boomers are a generation, a special generation, that have a vast majority of wealth in the world right now, as well as political control. And here, the BIS is over here discussing the second phase of the credit cycle, where credit losses are suddenly realized by financial institutions and how this will create instability and liquidity issues within the banking system. When the boomer reptilians tell you their plan, you better pay attention, because they cannot lie about it. They have to tell us the truth about what they plan with the world, and they have plenty of videos that tell you their agenda long in advance. That's what I revealed in this video titled 100 Reasons Why XRP Will Hit New All-Time Highs in 2024. And we're in that moment in time right now where a fireworks display is going to occur one way or another. Problem, reaction, solution will lead to generational wealth for the XRP community. But before we can get there, I have to call everyone in the XRP community out. In my next video tomorrow, I'll be giving everyone my #1 critique about the XRP army and how, with one change, we can all multiply our wealth phenomenally. If everyone in the XRP army does this one thing. Stay tuned for the next one. And I hope every single one of you enjoy the new way I'm making content on this channel. Ladies and gentlemen, this is the Bearable Bull here. Thanks for tuning in. As always, I appreciate every single one of you. Now I leave you with a message from the boomers.
What we have seen so far in terms of market disruptions or market stress has been associated primarily with the materialization of interest rate risk. But the next leg that and the question is not so much whether it will take place, but how intense it's going to be, is the materialization of credit losses. And that's basically what's related to the credit cycle and the weakening in economic activity. And so at that point, the question is going to be how resilient the overall financial system is going to be in order to absorb those losses, and particularly how large and persistent those losses are going to be.
Previous reports, you've warned us about the property market issues and it potentially being one of the next shoe to drops. That has seemed to have gained a little bit more traction in recent months. What's your latest view on that risk ultimately?
Very briefly, just a couple of points. Let me sort of make a distinction between the commercial real estate segment and the housing market. Commercial real estate, that's a sector which is facing headwinds, both from a structural and cyclical perspective. And I think that conditions are likely to deteriorate further from where we are. And we could see some strains both among financial banks as well as non-banks. As regards the housing market, something which has been puzzling, at least for us, but I guess not only for us, is the fact that in quite a number of countries around the world, what we have seen is that lately house prices have actually stabilized or indeed started going up again. And then whenever that happens in a number of countries, the question is, well, what's going on? Especially what's going on at a time when the economy is weakening. So this is rather unusual. Now, of course, you can have many explanations that apply to individual countries, and I've heard quite a number of them. But the phenomenon is so general and is happening very much at the same time across borders that suggests that some common forces are at work. Now, exactly what those common forces are, or at least what the relevance of them is unclear. Now, some of them are structural, in which case they provide some sort of comfort. For example, I think one can argue convincingly to some extent that what we have seen post-COVID is a fundamental change in preferences, with people asking for more space because of the working from home. Another aspect, however, is more conjunctural, and I think it's worth reflecting on because it ties back to what I said at the beginning. And it is the fact that financial markets are seeing that the interest rate cycle, the monetary policy, the peak in monetary policy tightening has been reached. And this goes back to the risks that I mentioned at the beginning. That could well be the case, but the risk that inflation might turn out to be more stubborn than expected is something that we should not rule out. And if there is a fundamental common factor behind all the types of vulnerabilities that we see these days, is that they are, to a large extent, the legacy of a period of very low interest rates that lasted very long. And therefore, business models, trading strategies that were predicated on that assumption are particularly vulnerable to current conditions.